Hello everyone, it's Josh again, and today we're going to be talking about home mortgages. There are several options to consider when purchasing a home, between fixed rates, variable rates, and different time frames. Most people shop for a home based on one number, the monthly payment. It's a trap, because while two different loans might get you the keys to the same front door, one leaves you wealthy in your 50s and the other keeps you writing checks into your 80s. Today we're going to visualize exactly where your money goes. We're talking 15/30 and the controversial 50-year mortgage. Which one is a lifeline and which one is a weight around your neck? First up is the 15-year mortgage. This is the rip the Band-Aid off approach. Take a look at this cup. This represents the total interest that you pay to the bank. Your monthly payment is going to be higher, sometimes 30 to 50% higher than the standard 30-year loan, but so much more of that is going towards the principal and gaining you equity faster. You aren't just buying a house, you're buying time. Equity, the part of the home that you actually own, at lightning speed. This option is for the disciplined. If you can swing the payment without eating ramen every night, you'll be mortgage free while your peers are still halfway through their journey. Now let's look at the gold standard, the 30-year mortgage. Notice the amount of interest paid to the bank. It's about double the cost of the 15-year mortgage. That's the cost of flexibility. This is the sweet spot for a reason. It offers a lower monthly payment, which means less financial stress if you run into a financial emergency or life happens. The secret to a fixed 30-year loan is that it's a maximum payment, not a minimum. You have the flexibility to pay it off sooner by paying extra towards the principal whenever you want, but you aren't forced to if you have a bad month. However, if you only ever end up paying the minimum, you'll end up paying for the house nearly twice over by the time you're done after 30 years. And then there's this, the 50-year mortgage. It sounds like a good idea for first-time home buyers in expensive markets because the monthly payment is the lowest on the menu, but look at all of this interest that the bank makes. You're stretching interest over half a century. You could be paying for your starter home well into your retirement. In the first 10 years of a 50-year loan, you're barely touching the principal. You're essentially just renting the house from the bank. It is the most expensive way to buy a home. You save pennies today to lose gold bars tomorrow. So which cup do you want to fill? Pick the 15-year if you hate debt and you want to save tens or hundreds of thousands of dollars in interest and have the income to afford the payment. Pick the 30-year if you want a little more flexibility and affordability every month. Avoid the 50-year unless it is a temporary stepping stone in a high appreciation area, and even then proceed with massive caution. At the end of the day, a mortgage is a tool. Whether it builds you a house or a cage depends on which timeline you sign up for. Feel free to ask questions in the comments or reach out to us directly to discuss some real-life numbers and see what actually works best for you and your situation. Don't forget to like and subscribe if you want to keep your money in your pocket instead of the bank's. And as always, at Rogny Homes, we help your dreams find their address.